Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's episode, I'm going to be having another conversation with my good friend Joe DeFazio. We have been looking forward to future conversations from the very first time that he was on. So if you haven't seen that first episode, make sure to get an introduction to who Joe is and what he's doing in the wide world, because we're just going to be having a conversation in general about finance and infinite banking, whole life insurance, life. And I hope you enjoy.
Good. Get you a little bit of exercise early morning. Cold air in the lungs wakes you right up. Then I don't know if you saw this on the Punjabi or whatever. I put a little post. I just was thinking when I was running that I was reflecting on how right now certain politicians are like, we need to tax unrealized gains. We need to tax businesses because of price gouging. We need to tax so on and so forth. And I'm just thinking through, like, as a financial advisor and tax professional, I'm like, maybe everyone isn't aware, but the IRS requires the pursuit of profit in order to get all the benefits of being a business. That's an IRS rule. If you don't, it's a hobby. You can see that. You can see contract law suggest the board of directors is required to act as a fiduciary to the shareholders, and the shareholders want profit. So the board of directors has to make decisions in the pursuit of profit. If there's profit to be had, they have to pursue it. The government steps in with inflation, causes, spending out the wazoo. We'll figure it out later mentality. Mm-hmm. Federal Reserve screws with the interest rates. The net result is inflation, prices go up. Shrinkflation, the size goes down, and skimpflation, the quality degrades. So some variation of those three, the business has to do in order to maintain profitability by statute and required by the IRS, or they lose the title as a business and all the advantages that go with. Now, here the politicians come and say, look at these people price gouging. It's like, well, wait a minute. The root cause was government policy and messing with the interest rates, not that they are required by statute to act in the pursuit of profit. That's like, why are we attacking? That's very silly logic. But that's what was going through my mind when I did my run this morning.
I gotcha. That's maybe what my pastor would say is the tail wagging the dog.
Yes, sir.
And it's so contrary to to where the consumer thinks that the blame goes. But business is business, and you use some words that I'm not familiar with, but supply and demand. And okay, if something moves over here, well, who would that have been? Einstein, opposite and equal reaction, If something changes over here, it's got to have an equal and opposite change over on this side. So, yeah. Oh man, that's interesting. That whole direction, especially with everything that's going on here in North Carolina right now, makes me think of some other real life aspects of conventional banking, finance, et cetera, that come into mind. Like I just saw on my social media feed where somebody in this type of an atmosphere that we're going through in the wake of a hurricane coming through Western North Carolina means that the places that are open, and many are not, right? But the places that are open need you to pay cash because they can't do stuff online and digitally, et cetera. And, lady goes to her bank, not asking for a bunch, right? $1,000, $2,000 just for those necessities in the here and now, right? But think about this, and I don't have to tell you much about it, but if even a portion of that one community or that one town feel the same thing, have the same needs, and they just want to go to the bank and just get $1,000 or $2,000, if they do that at the same time, of course that bank teller is going to tell you, well, actually, we need you to only, and, start making excuses and trying to dial you back. And, here the people are saying, listen, I need a generator. I need food, or I need whatever. Right. And they're just wanting a minimum. So yeah, I don't know. That's one thing that's been on my mind as well.
Yeah, that's like, it's nothing new under the sun. You go back and watch It's a Wonderful Life, Christmas movie.
Yeah, we like that.
There's a Run on the Bank. I love that movie. There's a run on the bank, and what's he doing? He's like, how much do you need just to get through the week? How much, like, don't take everything. How much do you need? Consider it a loan. Like, it sounds like that's such a thing of the past. That could never happen today. Well, actually, under the right circumstances, this whole economy is primed for that. We are leveraged multiples, like, as much as you could possibly be.
Right.
They're in the nosebleed. That's how leveraged things are right now. Right. One little touch of the house of cards.
Yeah.
Not going to be pretty.
And people start saying, well, I'm going to change banks. That bank's not going to be any better off. That credit union's not going to be any better off. It's all a house of cards. All right. So, yep. So all this is fresh on my mind, right? Like the desire of having continued conversations over the phone, and here, of course, where we could talk about things that are going to impact people if they're listening and paying attention. And obviously, if they're tuning into a podcast like this one, they are going to be. And we've already, been having discussions that I think are important. Me talking about things that are happening here in North Carolina, where we've just had a hurricane come through, and folks are dealing with some real life issues, and so many things pop into my mind, Joe, and I don't know where the conversation is going, but all these things that we've heard, well, the average American family couldn't weather an emergency because they don't have a $500 or $1,000. You hear those kinds of figures thrown out there, emergency, if it just popped up, right? And then I was telling you a moment ago about how, people that I know here in our communities of North Carolina dealing with the repercussions of the wake of this hurricane that's come through, needing to use cash. And there are those, and there's a dichotomy out there in the financial world there, right? Where some people say cash is king. Others say cash is trash. And I can understand and appreciate both of those sayings. But also the real life, boots on the ground reality is that, people needed cash to be able to do business, to be able to buy food, right, from these stores. And these are just the stores that are open. Needed cash to be able to buy food, and they're going to a bank and saying, well, hey, I need $1,000 or $2,000 for this emergency. And if you have a lot of people that feel that way, which everybody is feeling that way right now, they need propane, they need food, they need water, they need, they don't have power, they don't have signal. That was a big thing. And that means these businesses don't either. So again, the need for cash right there. But if you got to run on the bank, and we were already talking about that, and we can hopefully reference that. I like the It's a Wonderful Life movie too, like you were saying, where you hear about whole life insurance. So I don't know, maybe just kind of pick up where we were, Joe. I don't know where it's going to go. I've already been talking a lot. I introduce you, and then I haven't even let you speak yet. So I like It's a Wonderful Life as well. How are you today? Let's talk.
Hey, I am wonderful. I am alive and healthy. Loved ones are alive and healthy. I mean, we're off to a good start. So,
yep.
I love that movie. That is, that's a favorite holiday movie for me. And not for nothing, when I was a kid growing up, I didn't understand what I was watching, but there's a scene in there where, two scenes. One that mimics exactly what you're saying. It's when the main character's about to leave for the honeymoon. The two main characters are about to leave for the honeymoon. They turn around and their bank and loan is suffering from a run on a bank, which just everyone panics and they want to get their money out for whatever reason. And
want to or need to, right? Could be a legitimate need.
Could be a legitimate need, like you're describing right now in North Carolina. It could be, I need $1,000, $2,000, $3,000 to get me through the next 2 weeks for all those items you were talking about. Do banks have hundreds and hundreds of thousands of dollars in the vault? Shocker, they don't. If you try to withdraw a lot of money, not only will they ask you to fill out a bunch of forms, they want to know why. They report it to the IRS. They can delay it up to, I think, 60 days. Imagine that. Like, you need to put groceries on the table. And they're like, well, technically you're just a creditor to the bank. I know it's supposed to work like you come in and just get your money, but in extreme situations, we can make you wait. That's kind of scary. In the movie, he's going back and forth with a lot of his customers that are, in the community, a lot of his clients, and he's asked, people will come in asking for the full balance, and he'll get them down to like $23 or like $10 just to get them through the week. Which if they ask for any more, I think at the end he has $2 bills left, if I remember correctly, and they they put the $2 back in the safe, and they're dancing around because they can stay open for another day. But that's a real thing. That's a real threat. Another piece of that movie I really like is when again the main character has to go to the antagonist and sits in his office, and he's like, "Well, how much equity do you have? And what about stocks, bonds, cash value life insurance?" And you do a little bit of digging in history, and like the three main assets people had historically were pensions, life insurance, and real estate. There was a very small portion of society that had access to stocks. So it's really cool to see like the reference back in that time frame to say, wow, that was a cornerstone of financial, wherewithal of your financial landscape as a family, as an everyday average Joe and Jane, like a pension or an annuity and life insurance and real estate. It's pretty cool to see that callback. I love it. Every time I watch it, I'm like, and most people it doesn't even register. It's just a weird scene in the movie, but it's like, that's a really cool example of the mindset back then.
Yep.
If it's cool with you staying in this vein, I was going to share, you remember the grid we went over several times where it shows kind of like hostile, friendly. I don't know if this is going to work, if I'm allowed to share my screen or
yeah.
It's going to be like.
Let me put a pin in this real quick then. And I wondered if, I figured that we would be able to get here on future episodes. So for everybody that is just listening, make sure to check out the YouTube version, because one of Joe's gifts for sure is the ability to be able to visually demonstrate some very important principles. It's one of the things that I've always praised him for, and because I appreciate it, and I appreciate it, Joe. And I thought about this, when thinking about us having a conversation today, that I appreciate it on the receiving end. Now I might doodle some stuff out, and I like visuals, but I don't know that that's the best way that I personally communicate either, though. So I feel like I'm a good receiver of that, so that's why I can sing the praises, right? But I don't know that it's my, my particular gift either. So yes, I'd love you to. I'd like to also, though, touch base on some of these things. So don't lose your train of thought. Right? I'm not trying to cut in on you. I want to see the visuals, and I want you to keep going wherever you want to go. But let's consider those three things that you brought up real quick: stocks, pensions, whole life insurance.
Oh, sorry. Real estate. The big three originally, stocks didn't come on the scene for years and years later. It was not as commonplace as it is in recent history. Like there was no, let me just go to E-Trade and buy real cheap shares, or Robinhood and buy reach. Like there was a broker involved. It was a big process, and a lot of people, you needed serious capital to commit to. In fact, in the same movie, remember his buddy was like, if you have money, put it all in this company. Yep. Right. And he was like, we don't have sorry, we don't have the money to do it. It's like, it just goes to speak to like, the scale and the I guess economic separation between the two classes of people. It was kind of like a privilege to be able to buy into shares. Not everyone knew how to, not everyone knew a stockbroker. So like the information gap was there, and then the wealth gap was there to be able to do it. But it was real estate. Everyone could get their arms wrapped around, and insurance and annuities, pensions.
Okay, I got you. All right, so let's then, if we assumed, and it's a big assumption, if we assumed that people had access to all those three options, right? Stocks, is there volatility there, Joe?
Absolutely.
Okay. All right. Yeah, not a trick question. I don't like asking trick questions. I'm just thinking out loud here with you. These are the types of things that I would ask when evaluating an entity, right? Are there guarantees with stocks? Okay. So
the only.
Go ahead.
The only guarantee I would say is like you're guaranteed a certain position in a liquidation of the company. But are you guaranteed to get any money back? No. Is your investment guaranteed? No. You're guaranteed to be sitting at a certain, like if you had a preferred stock, you're guaranteed to be above, common stock. But that does not guarantee, common stock does not guarantee you're going to get all your money back.
Right. Doesn't guarantee an actual return just because you own a paper that says you're a preferred owner of this stock. Right. Exactly. And those are just a couple of questions. Right now, pensions, plenty of people would say that pensions had their day and they did what they were supposed to. But I think the more you look at time frame, how big of an impact did pensions have in the history of man? You know what I'm saying? It's not even a blip on the radar as far as longevity is concerned, right? Not even a blip on the radar. And I have conversations still with, older clients who still have pensions, but they also recognize that their kids aren't going to have that as an option. Their grandchildren are not going to have that as an option. So it's not even a blip on the radar. And then you get to real estate. Well, same question, right? Is that a volatile space? Could it go up? Could it go down? Does it have guarantees? It's an interesting conversation, right? And I'm not saying don't have stocks. I'm not saying don't have real estate, but we are going to return back to this banking thing. So I want you to get to your visuals, and I don't care if you use your visuals if you feel it's appropriate to answer these questions. But I wrote down 2 notes where we're already at in our conversation. Banks don't have money. I think that deserves more conversation. Banks actually don't have the money. You and I know, and anybody who's read Becoming Your Own Banker, know a big source of where banks do get money from, actually, which is interesting. So I'd love to circle back to that, go deeper with that, and then that conversation on cash is trash or cash is king. So I'll put that in your lap. You use your visuals as you want, or just answer that verbally as you want, but banks don't have money. And then let's have that conversation about cash is trash or cash is king.
So I don't know, in my opinion, this is just my opinion, folks. This isn't in a textbook somewhere. I don't know that cash is trash or king. I think I put a higher priority on cash flow. So like when you say cash, I'm like, I have a big pile of cash in my account. That affords you certain latitudes. That allows you to go out and, in a moment's notice, in theory, you should be able to purchase something because you have cash. It's very, very, there's low friction to you be able to buy something. So for example, let's use the real estate, the last thing you were talking about. If you wanted to buy a house and had all the money in in your bank account, in cash, in theory, you could say, here's the money, let me wire it to you. Now I get the deed. Done. Everything's settled. Cash, in a way, is like the shortest term bond there is that we have in our society. If you think about what a bond is, someone gives you cash, they promise to pay you interest over time. Well, the shorter the duration, right? So a really long-term bond might be your mortgage, right? If the bank owns the bond, you're paying them the interest, and then eventually they get the principal back. The shorter the duration, so if you use government bonds, for example, bond and T-bills, the shorter the duration, the faster they get their principal back. And in theory, the lower the interest they get. Well, if you take that to its natural conclusion, because T-bills goes to cash, there's no interest and it's settled immediately. As soon as I give it to you, I've paid the debt. Right? So the problem with that is, again, you don't have complete access to the money in your bank. If you try and take the money out of the bank and give it to the mortgage company, there's going to be a lot of red flags. They like you to stay on that platform, in that environment. You could say, hey, this bank sent it to that bank and we're done. And everybody's happy. But if you say, hey, give me the cash, I'm going to give it to the other bank to pay off the mortgage, they have a problem. Whereas for me, and it kind of alludes back to that, the idea of a pension, which is just a fancy way of saying annuity, the stream of payments you can't outlive. If you have cash flow in perpetuity, the certainty of your financial situation is through the roof. Cash sitting there can be useful in the short term. It can be useful, hopefully, in an emergency, but as we just kind of discussed, maybe, maybe not. It depends if they freeze things, if they limit your ability to move money. If they don't like you, they can freeze the account. They can flag your account. I'm not kidding. If they flag your account, you're dead in the water for 20, 30 days. Can't move anything in and out of the account.
They might just change their minds.
They might just change their mind, yeah. But cash flow, if you have this flow of money that constantly replenishes, it makes the decision to spend easier, both financially and psychologically, because you know more money is coming. And honestly, if you think about it this way, corporate finance prioritizes cash flow, whereas personal finance prioritizes cash. This is kind of why I'm going to circle back to my illustration here. Corporate finance is cash flow based. It's all about meticulous decisions on what to invest in. They're taking all sides of the equation into account instead of only maybe half of the equation into account. So all costs of capital they take into account. They prioritize their own capital over simply spending the capital. They prioritize assets over expenses. Personal finance, interestingly enough, is like the exact opposite. What do we prioritize? We prioritize a balance sheet, not cash flow. The number one problem people and fear people have going into the retirement age is, am I going to run out of money? Well, you prioritize the balance sheet, and now you got a pile of cash in some form or another. Like the capital is maybe in a mutual fund or in an ETF or literally in cash, but it's just static. It's sitting on your balance sheet. It's not generating a cash flow. So you have to spend down that pile of cash and capital. What else? We prioritize expenses. I mean, you want to look at the GDP of the United States of America, we're a consumption-based economy. 70% of everything, it's all debt-based. 70% is consumption, private consumption. We adopt the same philosophy the government does in that spend now, we'll figure it out later.
Right.
Right? We spend beyond our means, figure it out later. It's their mirror image. The corporate finance or corporations and businesses are producers. Personal finance is about consumption. Which one's more profitable, consuming or producing? Which one's more sustainable, producing or consuming? So if your financial affairs are set up to just consume, I think that's the crux to the problem here. You've been and it's not. I don't want to remove too much of the blame, but you can't blame the average Joe and Jane when the marketing and the general consensus is always to be a consumer. They're constantly advertised, and they're constantly advertised. The best way, make sure you have a big pile. Like I remember these ads by, I think it was ING. What's your retirement number? 1,674,320, and it would be above their head when they're walking down the street. That's the balance sheet I need so I can live in retirement. Is that the best way to approach this? Maybe. I would say if we were to judge the fruit of the tree of that advice, well, what's the problem with all the retirees? Is everyone retiring a multimillionaire? In the most prolific time period of humanity in America? How come everyone's not 1 million, 2 million, 3 million? Easy. Don't have to worry about it. I don't know. Maybe we're missing something. But yeah, if it's okay, I'm going to try sharing.
Yeah,
for those just listening, I apologize.
No, it's okay. Yeah, I think definitions are important because, like you're saying, we've been marketed to, and this has always been an interesting thing to me. Anytime I've ever heard this in a seminar or a conference where someone will point out just how marketed to we are, they'll just sing or hum or whistle those ba-da-ba-ba-ba, and everybody knows what company, what product, just off that jingle, right? Just off of a jingle, everybody will know, oh, that company and that product, that company, that product. And so I won't try and do any whistling or any more singing or anything like that right there, but you get the point, right? And if you have that done half a dozen times, you realize, wow, that's just up in my head, right? So yeah, we constantly are bombarded with marketing, and then we don't have real definitions for things like you talking earlier. I would say, most people really don't think of dollars, money, as an IOU. They don't think of it that way. They don't think of it that way, but it's an IOU. That's what it is. That's its definition. And then you could talk about all these other things. And then once you have them defined and you look at their characteristics, whether it's the pensions, the stocks, the real estate, whole life insurance, that's a big thing I think that's missing is just, well, people don't know what money is. They would never in their own words say, I did. And I'm saying that like when I saw infinite banking in 2015 and that was the first time I'd ever had anybody ask me, what is money? I'd used it for 30 years, decades, right? I'd used it for 30 years. I'd spent it for 30 years. I mean, to your point, it's like I was not a producer. I was a consumer. I was spending it all. I wasn't keeping it all. I was not cash flowing it, right? I was not seeking to put it into appreciating assets, etc. All the things that I have been doing for a decade now because I was marketed to, and I didn't know how to answer that question when I was asked the first time in 2015, what is money? The dollar's in my pocket. Why are you even asking such a stupid question? Was what part of my thinking was, but I knew it was important too, though, because nobody had ever asked me before. I'd never been forced to define any of this. So, all right, keep going. I'm enjoying this. Where are we going with our visual in the conversation?
Before you jump to the visual, I want you just hit on like a chord, and I think people need to really hear that and marinate on that. For your active listeners, Plato, I think I quoted this last time we spoke. Plato had a quote. Most people are not just comfortable in their own ignorance, but they are actively hostile to anyone who points it out.
Right.
That kind of speaks to this idea that, like, once it's in there, once that jingle is in your head, you don't want people to remove, like, the fact that you didn't know something. Like, they don't want you to point out the fact that you didn't know something. What is a dollar? Your natural instinct was like, what the heck are you asking me that for?
Oh, listen to your accent coming out right there. This is going to be so fun for everybody listening. I sound like a hillbilly. And that was your real, I don't know. I don't want you to get offended. Northeastern. Maybe Yankee is what we would say down here. But, don't spit your coffee out or whatever. Yeah. Your Yankee accent's really coming out right there. What are you talking about?
Yeah, what are you talking about? there were hand movements too there.
Oh, yeah. We need that on the screen.
Yeah. But it kind of speaks to this idea that, like, and this is bad, the way I'm going to just keep this in mind, that I'm trying to relate it to finance. It's like financial Munchausen syndrome. You've been indoctrinated, like every commercial, as soon as you're whoever says something like, oh, buy term and everybody knows the jingle.
Right.
You've been, like, crushed by all this marketing.
What was that syndrome you mentioned? You mentioned a name there and I didn't catch it.
Oh, sorry. Financial Munchausen syndrome.
Okay. All right. Yep. I still don't know.
You're made to believe you're sick and you're not.
Okay. All right.
So you're made to believe something that is not true. But it's like the doctor says it, your parents say it, so you start to believe it. You think you're sick even though you're not, because you've been told so much that you are sick.
I got you.
It kind of creates this financial, it kind of leads to like a financial Stockholm syndrome, where eventually you've heard it for so long that you're going to defend that. You fall in love with that theme. You don't want to be broken away from that. It's this herd mentality. It's groupthink. And once you break that, it's like, oh no, you're outside of the herd. And like, there's so much psychological, there's so much going on that when you lose your herd and your identity, that's a really scary, dangerous place. And people hate danger. They'd rather seek to be in like what was hostile to them, but they had a herd and they knew, rather than to not know. That feels more dangerous, to be outside of the herd. It's kind of like, I think we referenced this. It was like the Israelites.
That's exactly what I was going to point you to. Yes. Yes.
They were free from Egypt and they're free now. And then they're like, what do we do? Well, they start complaining. Like, oh man, well, at least back in Egypt, we had, 3 meals a day, man. What are we doing out here wandering? We're going to die out here. Right. And they don't even know what to do with themselves. So you have to, like, these images that I'm about to show, they're designed to hopefully slowly peel back the scales and the layers of the onion, as to not just like jerk someone out of their herd, and then they feel like naked out in the wilderness, right? Freaking out. All right, so let's. Jesse, would you mind allowing the share feature?
Yeah, but that is exactly what I was thinking as you began to describe that. I began thinking of, yes, the children of Israel fighting against the freedom of freedom. No overlords, no masters, no servitude, but they were whining and complaining and fussing for what Egypt had been. Crazy to me.
And take it a step further. Later on, it Judges. We need a leader. We need a king.
Mm-hmm.
It's like, you were established without a king, but they begged and wanted and needed a king because everybody else had a king. Munchausen syndrome, Stockholm syndrome. Oh wait, we need to be just like the herd, just like everybody else. He's like, he's establishing you to be above that.
Yeah, I was just talking with my boys about that. My boys were just asking me, Daddy, are there still kings, and who has a king? And that leads us to talking about different countries in the world and the different governments that are out there, and talking more about how ours is set up, of course. Very interesting, very relevant. All right, see if that doesn't let you share screen now, Joe.
Perfect. There we go.
Yep, now I've got it.
Perfect. Okay, so try and breeze through this. We'll start on the perimeter. It's kind of like and then we'll compare the northern portion to the southern portion here. It's color coordinated. You're going to see a friendly in green, hostile in red. There's a line across the middle. Each side has 3 blocks above and below the equator, we'll call it. In the bottom, this is where you're going to see a lot of the most traditional financial planning and thinking. I call this more of a hostile environment. The 3 blocks are going to be hedging, gambling, and speculating. Those are the 3 things we can do with our money in that hostile environment. The main distinguishing characteristics I used here were your potential for loss, gain, and how much control you have. If we look through that context, it kind of tells us a much easier way to classify what we're doing with our money. Now, let me stop here. If you were to use this language and this framework with the average financial professional, it's not going to go well. They tend to call speculating investing. They tend to call saving investing. Like they'll say, how many people say, I'm saving in my 401k?
Yes.
I'm like, not if we classify things properly.
Yeah.
So I took a little bit of time here to come up with this framework. This is something I use with my clients, and it really helps drive home what we're doing. So the point of this was to say there is a big difference between investing and speculating. So investing, actually, we'll go to this one because it has some of the examples. Sorry about that. Investing would be if you own real estate, rental real estate, if you own small businesses, intellectual capital, if you sell copyrights or patents or license things in that regard. Speculating would be the stocks and bonds we were talking about, mutual funds and ETFs. So those, you tend to just give your money, your capital, to someone else to do something for you. You have zero control in that equation. You cannot call the mutual fund company up and say, I don't like this stock. Can we put a little more of that stock? They will. If you can get through the phone, they're going to hang up on you. You have zero control. You can't call Apple and say, hey, I own 4 shares of Apple. I don't like the size of the phone. Could we do something about that? Maybe make it a little bit bigger? They're going to hang up on you, right? But if you own the business, if you invest and own the business, you can, change the logo. You can change the size of whatever the phone is. You can paint the walls pink or black or whatever you want to do. You're in control. Same with rental. You own it. You call all the shots. You're the decision maker. Speculating, zero control. Investing, control. That's the main difference there. In the bottom hemisphere, the hostile environment, everything's zero sum. Right? By their nature, stocks and bonds, these are exchange traded instruments. They're securities. So if someone's winning, someone else is losing. It's zero sum. And most of the time, the house is winning. So everyone else is losing. If you're not part of the team house, you're losing. You have to wait a very long time to see an appreciation of your assets. Along the bottom, another key difference here is you're operating in the hemisphere, the hostile environment. It grants you asymmetric risk. And just to kind of real quick review what that looks like. A very simple diagram here. Big risk, little reward. In a friendly environment, it's the opposite. Remember I talked about businesses make calculated, meticulous decisions. You're trying to take small risk for outsized reward. Big rewards, small risk. Most people, when they think they're investing that way. When the reality is they're investing big risk, small reward. Right. They give up all control for little reward. They give up all ownership for little reward.
Like when I see this, right, I'll just share my thoughts as you showed that particular visual. If you're showing someone this, saying, hey, there's a space, an environment where you in the bottom part are assuming a big risk, you, the person, for a potential small reward, or in a different environment. And you get to pick, you get to choose. You can invert that and you can assume a small risk with a big reward. Everybody's picking the top. Everybody's picking that friendly environment. Everybody wants that. But you're saying that we're not marketed to understand this. We're not taught to understand this. We don't know the definitions. We don't understand the characteristics, or we're just so busy, being a husband and a father and pursuing a career or whatever, that we aren't taught to take the time out to look at properly classifying which entities are in this hostile environment and which ones fit in the friendly one. Those are my thoughts. What do you think about that?
Yeah, you are spot on. Whether it's you don't have enough time because you have plenty of other real commitments in your life, or the combination of you don't have time, and between school, family, church, temple, all your community groups, no one talks about it. Mm-hmm. So the only information you're getting is from that marketing. So if those two things collide, yeah, it makes sense. It makes sense. Most people don't even know the top exists. They don't even know this is an option.
Right. Nobody sat us down in high school and was saying, hey, which of these environments in your financial life would you like to fit in? Nobody did that.
Exactly. No one did that. Not at all. And even, let's even take, you asked your audience, what's the definition of like risk? Like people generally have a instinctive understanding of what risk is. It's for most people, they're going to say, oh, I could lose something. I can get hurt. But that's risky. But in this hostile environment, risk is not defined that way. Risk is defined as an unexpected return. That seems very vague. So I'll give you an example. If your portfolio, we'll say you like stocks and bonds because you're going to hedge by term. Hedging is, we'll go through that in a second, but by term, and invest the difference in mutual funds. Notice it's all in the same hemisphere. If that portfolio then achieves a different result than you were expecting, that's what they classify as risk. Now, I didn't say it was worse. It's limited to what's worse. It's just different. So if they thought they were going to achieve 6% and they achieved 9%, your portfolio manager considers that risk. Let me pause for a minute. Like, think about that. You made a good investment that turned out to be a wonderful investment. Instead of achieving whatever you thought, it achieved almost 50% more than you thought. That's risk. I mean, one definition. Depends on who you're talking to, but they consider that risk. Now, of course, on the like if it was they were targeting a 6 and they came in at a 3, a little bit lower, they would say that's risk too. That kind of makes sense intuitively. Yeah, I did worse than I thought. I left some on the table or something. But the idea that gains are equally as risky as losses seems a bit strange. And going back to that asymmetric risk, in order to achieve a higher return, you're told you have to take on more of that type of risk.
Right.
That new definition of risk.
That's definitely what we're told.
Does that make sense? And most people aren't taught about a different way to do this. So the whole top here, trying to cover it, but the whole top is a mystery. Like, I guess that's what we have to do. I guess that's what risk is. I guess I just have to ramp up as much risk as I can stomach in hopes that we hit that return using something I have zero control over. And if I win, Jesse loses, or Jesse wins, I lose.
Let me ask you something on that point, because this is a pretty recent revelation for me, right? And I've been in this way of being my own banker for 10 years now, going on 10 years. But traditionally, I've gathered that we're told, because I had the things, right? I had the 401k, I had a state retirement, I had a background as, a law enforcement officer and a high school Spanish teacher. So, all the traditional things, qualified plans, etc. But in general, it seems like this is the pitch, conventional finance. While you're younger, take on more risk because you have more time to be able to make up for that or adjust, etc. And while that could seem to have some superficial sense to it, I've been realizing some things, right? Because you and I speak about compounding a lot. For example, like when talking about cash flow, we speak about compounding cash flow. And knowing how uninterrupted compound growth works makes you realize, well, actually, on this end of the angle, where the angle begins, right, a small difference makes a much bigger difference the further out in time that you go. So actually, those $50, those $500, those $5,000 decisions that we made 10 years ago, what does that equate to now, 10 years later? Oh, there's no telling. But so the cost of capital and EVA and all that kind of stuff, interrupting the compounding that could have been going on for you. I'm just trying to point out that, the financial advisors out there traditionally are saying, well, yeah, you're young. You should be aggressive. You should be assuming more risk. You should be putting all of, your capital here. And me and Joe aren't making financial advice. We're having a conversation about these things. Don't sue us. But we're told that, right? When we're younger. And then, okay, yeah, well, as you get closer to that retirement age, that passive income time of life, sure, we'll start transitioning to the more, conservative, and that's a loose term, I feel like, but the more conservative selections, right, on these things. And that makes me think of another question, Joe. Like, I remember when I was first introduced to IBC, I had a guy ask me, do you have a 401k? Yes, sir. I've got a 401k. And he said, I'll bet you don't know crap about that 401k. Maybe you know two things. Maybe you know two things. He said, other than that, you don't know crap about a 401k. He said, maybe you know whether your number went up or down last quarter. Maybe you know that because you actually opened up the mail and looked at the statement, right? And he said, maybe you know if you picked a mild, moderate, or aggressive risk setting on that. And I was like, yeah, I am the kind of guy that I do open up my mail. So I saw whether the number went up or down, and I knew which of those three selections, those three options that I had, right, from the start. And he was right. I didn't know anything other than those two things on a 401k. But I think that's such a travesty, right? That young people are told, yeah, take all those money risks now. And I could understand some philosophical, right, entrepreneurial minded aspects to that kind of thinking. But I think, again, when you can properly classify what's what in the financial world, and you got accurate definitions on what money is, or what whole life insurance is, or what stocks are, or all these things are, okay, maybe you make the risk in that, okay, if you're entrepreneurially minded, yeah, launch a business, right? But think about these things that we're talking about: cash flow, guarantees, control, right? Properly classifying things. So I don't know. That's something that just kind of blows me away, that here I am actually paying attention to money and finance, and I coach other people, and I'm just now getting this realization that, oh no, when younger people take on more risk earlier, financially, that means a bigger difference of what could have been later on. All right. So that's what I was getting from what you were communicating. That's where you were helping me think.
I love it. So time is your number one asset, especially in the friendly environment. Time is the number one asset. It allows for compounding. Time is a crucial part of compounding. Ironically, you're going to feel in the hostile environment, they're going to always they're going to speak out of both sides of their mouth. What you just said, I've heard a million times. Oh, take the risk while you're young. You got time to make it up later. Well, wait a minute. To your point, if a dollar compounds the most, the earliest you start, because they all tell you start early, time in the market, not timing the market, start early. Why would it be okay to lose that dollar and start over later? You could never catch back up. If we're just math, like compound $1,000 starting at age 0, and then start compounding $1,000 at age 30. Tell me when they cross. They don't ever. So why would you say that?
All right. So pause right there. I think that's so deep. I think that's so important. So for sure, I did not want to interrupt that quality conversation that I was having with my good friend Joe. Make sure to check out part 2 next time. I hope that you've enjoyed this. I certainly have. You can find Joe's contact info in the notes below. And of course, you can reach me at durhamtalents.com. Remember to live and leave a lasting legacy. Have a great day. Take care.